morning, ladies and gentlemen. My name is Vasil Dikov. I am a senior account manager with GDMFX, and I will bring you today's market outlook. We'll start with the North American markets and the events from there. The import-export price index from the US month-on-month in the area 0.3% weaker than expected, 0.2%. Less than the previous at minus 4.8% and 0.5% better than expected, 0.8%. We also had the monthly budget statement of 18 billion, worse than expected at 6 billion. Now, the Bank of Canada is cutting its growth forecast for this year while still clinging to the belief that improving non-commodity exports will dominate the Canadian economic story, despite recent stumbles. While the bank kept its policy rate at 0.5%, on Wednesday it put the spotlight on one of the pitfalls of cheap money. Soaring home prices in the Vancouver and Toronto areas and the growing financial risks that brings. Governor Stephen Pauls warned it last month that Canada's housing market were at risk of a pullback. On Wednesday, the bank reaffirmed its concerns that record prices are luring residents to those hot markets into risky belief that only trajectory for home values is up. On the overall, the economy of the bank's thesis remained intact despite being tested by weak trade numbers. And on overall, import-exports will spur business investment, the creation of new firms, and the jobs that go with it. And moving on to the US, the Fed beige book said that the US economy continued to expand from mid-May through the end of June, but there was little indication that the inflation would surge anytime soon. We had the wage pressures, which were modest to moderate in most of the central bank's districts, and price pressures remained slight, the Fed said in the beige book report of anecdotal information collected from the business contexts across the country. The Fed policymakers have been spooked by a lack of sustained progress in moving inflation up to the central bank's 2% target, as well by a global growth slowdown. The US business investment also has been weak for 2 straight quarters. Today we'll have the employment change and initial jobless claims from the United States. The Dow moved sideways yesterday. Nasdaq also followed with a sideways movement. The Dixie was down to 96.21 from 96.39. Currency pair movements, the US versus the Canadian dollars was 85 pips down, US dollar versus the Swiss franc 45 pips down, and US dollar versus Japanese yen 70 pips down. Today we're going to have the initial jobless claims from the United States. Moving on to the European area, industrial production, WDA, year-on-year 0.9%, worse than expected at 0.5%, and industrial production seasonally adjusted for the month 0.4% weaker than expected at minus 1.2%. We had the German 10-year bond auction minus 0.05%. The biggest mover was the euro versus the New Zealand dollar, 120 pips up yesterday and 105 today. Moving on to the UK, RICS housing price balance 8% better than expected at 16%, and after weeks of political turmoil, some form of stability has settled in the UK as Theresa May took office and announced her cabinet. As a result, sterling touched its highest level versus the greenback in more than a week. The pound climbed 0.7% versus the dollar yesterday before dropping 0.6% at the end of the trading day. However, there is a fair chance that the sterling's upward move will be reversed after today's Bank of England minutes, a possible interest rate vote to the downside and increased asset purchasing facility. The FTSE 100 gained 29 points and closed 6,632 yesterday. The pound versus the US dollar was 145 pips down, pound versus the yen 250 pips down, pound versus the Australian dollar 180 pips down, the pound versus the Canadian dollar 300 pips down, the pound versus the New Zealand dollar 130 pips down yesterday, and the pound versus the Swiss franc 210 pips down. Overall, very big movements with the pound pairs. Today we're going to have the Bank of England Super Thursday, which is going to include an interest rate vote, the asset purchasing facility, the Mark Carney speech, and also the Bank of England minutes will be released later on today. Moving on to Asia, we had in Japan the foreign bond investment, which rose 2.549.1 billion yen from the previous 426.9 billion yen. And the foreign investment in Japanese stocks indicated capital outflow by dropping with 306.8 billion yen versus the previous of 113.6 billion yen. We had also industrial production for the month from Japan 0.3% worse than the previous at minus 2.6%, and industrial production on a yearly basis 0.3% worse than the previous at minus 0.4%. Also, the Chinese imports were 8% worse than the previous at minus 8.4%. The Chinese exports dropped to 0.7% worse than the previous at minus 4.8%. Chinese trade balance 13.57 billion worse than the previous at 311.20 billion. Trade balance USD from June, and also the rally that drove Asian stocks to level last seen in April showed signs of lagging as investors await details of Japan's stimulus plans and the corporate earnings season begins in earnest. Japanese investors purchased the most overseas bond ever last week as local yields plunged to uncharted levels below zero, helping drive a record-setting rally in the US Treasuries. Moving on to the Pacific side of the market, we had in Australia the Westpac consumer confidence minus 2%, less than the previous at minus 3%. From Australia, consumer inflation expectations 0.2%, better than the previous at 3.7%. New Zealand business NS PMI 0.5%, better than the previous 57.7%. Australia added jobs in June, led by a rebound in full-time employment as record low interest rates and stronger business confidence boosted hiring. The currency rose, employment rose with 7,900 from May. Economists forecasted for a 10,000 job gain. Jobless rates rose to 5.8% from 5.7%, matching economists' estimates. Full-time jobs jumped by 38,400. Part-time employment fell by 30,600. Participation rate, a measure of labor force, as the share of the population rose to 64.9% from 64.8%. Economists were predicting a 64.8% reading. And finally, the commodity section of the market, the EIA crude oil stock exchange decreased by 2.5 million barrels last week for the week ending on July 8th at 521.8 million barrels. US crude oil inventories are still at historically high levels for this time of the year. Crude futures fell sharply on Wednesday, retreating back near 2-month lows as investors surged off a modest draw in US oil stockpiles, placing a greater focus on the sharpest build in distillate fuel inventories in 6 months. Gold pushed higher in North America trade on Wednesday, bouncing off a 2-week low, but hit overnight as investors assess the possibility of more monetary easing by the global central banks. The S&P 500 index had a range of 13 points at 2,146 right now. Gold had a range of $19 at $1,337 right now. Silver had a range of 58 cents at $20.27 right now. Crude oil had a $2 range down to $45.31. Natural gas is trading at $2.73 in the moment with a range of 10 cents. On Thursday, we're going to have the A natural storage change, and on Friday, the Baker Hughes oil account. That is all from me. Thank you and have a nice day.